theme of the memo is that there needn't be a firm schism or dividing line between value investing and growth investing. As you know, my son and his family have lived with us for a lot of the last year due to the pandemic, and he's a very thoughtful investor. We've had a lot of discussions on lots of subjects, including this one, and he laid out criteria for value investing based on the understanding of securities as stakes in actual businesses, focus on their true worth as opposed to their price, the use of fundamentals to calculate intrinsic value, the recognition that attractive investments come when price diverges from value, and the emotional discipline to act when such an opportunity is presented and not otherwise. And it seems to me that, number one, there's no reason that you can't do so-called investing in growth companies on that basis. And number two, there's nothing in there about low PE ratios or anything like that. So it should be, the point is the investor's mentality should be eclectic. And you shouldn't decline to invest in companies just because they're fast growing and carry high PE ratios. Is that you have to really know a company well before you know it's overvalued. If you say, well, let's screen on the market for attractive investments, and we'll say that any PE over 25 is discarded. Well, there are companies that are worth PEs over 25. I would say it's not easy.
Fair.
And it's not something everybody can do, but I don't think it's something nobody can do. There are people who have great records, and those records include investing in so-called growth companies. You know, I mentioned in the memo that there was a very famous value investor who made good money in some of the tech leaders. And I said, well, how could a value guy invest in high growth tech companies? He says, well, they look like value to me. And, you know, this is an avowed value investor with a long record, a great long record. And the point is that he was open-minded. And you shouldn't dismiss the point that one of the points that's important is just because something has a high PE ratio doesn't mean it's overvalued. And just because something has a low PE ratio doesn't mean it's cheap. Well, first of all, of course, in the short term, the market certainly can depart from irrationality. Secondly, I think you're implying that we're in a bubble, and certainly, you know, the greater question is, well, why is the market making new highs every day if we have these problems? The political division in the country is a terrific one, but the greatest one, of course, is the pandemic. But I really think that in large part, and this doesn't account for any one day's action, I think that the Fed and Treasury actions, and specifically the reduction of the Fed funds rate to zero, has had a very coercive effect on the market. It has required people to invest because they don't want to sit around with cash, money market fund, bank deposits, all earning zero. They don't want treasuries at less than 1 or high-grade bonds at 2. Mm-hmm. And so they've had to push out into risk assets, stocks, non-gilt edge bonds. These are private equity and so forth. These are and venture capital. These are risk assets. First of all, there's no disputing the fact that growth stocks have outperformed value stocks. On the other hand, I think there's no disputing the fact that what are called growth stocks have a better future than what are called value stocks. And of course the ones that where the value is questionable have not been heavily represented in the S&P. The ones that have been in the S&P for the last 10 years are the great tech leaders. That have been in the S&P for the last 10 years have probably been the acknowledged winners. But look, when one group outperforms another group for a long period of time, and to the extent you described, there's no question that it's possible that they're overvalued. the argument in the memo is that doesn't prove it's overvalued, because these are companies that have gotten better and better, that improve as they get larger and get stronger as they get larger, not bureaucratic and slow moving, but larger, and Tesla is an extreme case. There's an argument to be made that it's too high. The people who are buying it, you can't say that they're all nuts. They may have there may be people who have a view that it's attractive. By the way, people said it was too high 2 years ago.
True.
And so it has all the appreciations in the last 2 years been fallacious. Who are we to say? You can make judgments, and certainly if you describe an individual not of great means, he should take some profits. He probably has. If he bought Tesla 2 years ago, he probably has a huge gain. It's probably a very disproportionate amount of his financial net worth.
Yes.
He should absolutely cut back, unless he really wants to try to hit the long ball.
Howard,
to do that, he should have a high growth, a high pain threshold.